How's it going, everyone? It's Fortius here, and today I'm just going to be reviewing all the subjects that you're going to go through to prepare you for your final exams in the LLQP. And I'm going to be just showing you in a slide presentation so it's easier for you to take a look. And before we get right into it, just don't forget to hit that like and the subscribe button if you find any value in this video. Okay, so to begin, life insurance basics. So the first one, remember, term life insurance. That means that it's a shorter type of insurance and that it is cheaper. So this means that it covers a fixed period, and of course, there's no cash value in it. The next one is a permanent type of insurance, which is called whole life insurance. And here, with whole life, you get a guaranteed cash value, but that also means that you do not have the flexibility, and that's where the third one comes in. Universal life insurance. This means that you get to have a flexible premium. So instead of just paying either $50 per month, you could either increase it or lower it. Example would be from 50 to 40 or 50 to even 80 if you would like. And then with each type of insurance, there's this thing called a participating policy. Essentially, what this means is that when you're in one of the permanent life insurances, you get a dividend if you are a participating client, let's just say. So an example would be is if you were investing the $20, and then if you make some income from that $20, the insurance company would pay you what you earn and give it back to you in a monthly basis, either through a cash or they could just send it through your bank account. Next here we have accident and sickness insurance. So the first one is disability insurance. So what does this do? Of course, unlike if you're in the workplace, let's say a manufacturing job, you get a group insurance, which if something were to happen to you in that workplace, you get injured physically, your company would take care of you if you were out of work, and they would give you income based on the injury that you've received. And the difference with a disability insurance is when you're out of work and you happen to get in an accident and you won't be able to show up for work, then the insurance company, they would pay you a certain percentage of your income, but they would also do it in a monthly basis compared to a critical illness insurance. And so if we go to critical insurance or critical illness insurance, the difference with that is they pay you in a lump sum. So whichever face value that you have, they would pay you all in one payment. And with critical illness, instead of being disabled, what this covers are types of diseases or any sicknesses that you go through. An example would be if you get a heart attack, maybe a stroke, or even in the future, if you happen to get cancer, then that's when the critical illness insurance would take care of you. So then the third one, we have accident insurance. God forbid if something were to happen to you, got in a car accident, you're not the one driving, you were just walking, crossing the street, and you happen to be injured from that, that's when the payments would come to you if you were to get accident insurance. And then the fourth one we have, it's in the name, is long-term care insurance. So if you got this one, you just get an extended coverage for your nursing or home care needs. So essentially, if you got this, you would just have extra care. So let's start with segregated funds. This one is sold by insurance companies. And what segregated funds has compared to the mutual funds is that it offers a death benefit to your beneficiaries right away, and it bypasses probate fees. So compared to mutual, if something were to happen to you, it would go through your estate planning process, and then there would also be costs before you get the funds to your family. And that could range from, depending on the type of funds that you have or what the government has, it could take from maybe 3 months to maybe a year. And then that's why people get segregated funds. If you have beneficiaries, it would just go straight to them, bypassing any legal action or estate planning. Another thing that segregated funds have is the maturity guarantee. So what this means is if you pick a 10-year maturity guarantee. After the 10 years, you could reset your policy. So if you put in 1,000 and then it went up to 2,000 within 10 years, you can lock it in for 2,000 so that if the market drops and goes down, let's say 50%, so it goes back down to 1,000, it would prevent that from happening. So you could either choose an option of either keeping 100% the guarantee down to 75%. So if you did the 75%, you would only lose 25% of the 50% loss. Next is the higher fees of segregated funds. This would be due to the death benefit and the maturity guarantees that it provides. So essentially, segregated funds are a mutual fund just with an insurance wrapper around it, and it's also using insurance companies instead of the different kinds of companies that are out there. So if we look down here at mutual funds, there is no insurance guarantees on it. And then there's the probate fees that we talked about earlier. And another one is the lower fees. Or if you don't have any beneficiaries with you, let's say you're single like me, then you might just take this one because it's cheaper. But there's also your own free will, so you can choose on your own. Next, we have annuities, which is just the retirement income for Canada. And what this essentially is that you're giving money for the company to invest, and then they pay you back gradually, just not all in one. So the first one that we have here is the life annuity. So for throughout the rest of your life, it gives you an income that is guaranteed. And then the term one is it's if you just want it for a certain amount of years. The next is we have deferred annuity. You're paying now, but at a later time, that's when they start paying you, essentially when you retire. And then registered annuities. With this one, it becomes a taxed income when withdrawn. And what you could relate this to is the RRSP, Registered Retirement Savings Plan, and the income that you gain from that is taxable. Okay, key taxation rules. We look here, it says life insurance payouts. What that means is it's a tax-free to your beneficiaries. So let's say you had a death benefit of 100,000. If something were to happen to you, you passed away, that full 100,000 would go straight to your family or beneficiary and it wouldn't be taxable. Next, we have segregated fund gains. It says here subject to capital gains tax. So anything you gain for capital gains from the market, if you were to invest something and with what you earn, let's say if you put in 100 and it went up to 200, you would have gained 100. And out of that 100, the government would take 50% of that, which is 50, and then tax that into whichever tax bracket that you're in. Okay, RSP withdrawals. So when you withdraw from your RSP, it is taxable, but it is also tax deferred. So the point with this is that you invest your money in a retirement savings plan. You hold on to it until you retire. And then once you're done with work, your tax bracket would go down. And then that's when you can start taking money out of your RSP account, which you could turn into a RIF, a retirement income fund. And then that's when you can start pulling out. And then now there's the other thing called a TFSA here in Canada. Everything you earn in TFSA is tax-free. And the best part about it is that anything you gain from your TFSA account, all those investments, if you were to withdraw from it, it wouldn't be taxed. Next subject we have here is ethics and compliance. So it's always important to just know your client. As an advisor, you must make sure that you assess the financial needs of your client before you sell them things. So make sure that you know that your client can afford it and that they're aware that they're buying a product that will last in the long term, and make sure that they can afford it. Because it is not good if you sell them a very, let's say, a high cost product, and then next thing you know, they would cancel it because it's too expensive. And that would not be good. That would be just wasting your time, their time, and you're just not properly helping them out. Next one we have here is suitability principle. So In your client's situation, if you did assess their financial needs properly, take a look at their situation, it is up to you as their insurance advisor to give them the product that they need and the protection that they want. Third one we have is privacy laws. So this would probably just be common sense, but when you have your client's information, make sure that you don't send it to anyone else or anybody, unless, of course, you have their consent. And that is part of having integrity. And then the fiduciary duty. You are here to sell products, but you also must make sure that the products that you are selling to your clients is something that is best for their needs and not yours. Because once you start doing that, it would just put the industry down. And I'm pretty sure the industry right now, due to past experiences of people, it's not the best, but that's why it's good to always act in the best interest of your client. And maybe in the future, the industry will get a better name for it and all that type of jazz. Okay, key LLQP exam formulas. These are just the basic formulas that you're going to need for when you're filling out your exam. Just remember, net premium, it's the gross premium minus expenses and profit margin. There's disability insurance benefit, percent of your gross income, usually 60 to 70%. It's what the companies take. And then annuity payout, which is your investment divided by the expected payment years. Then as you can see here, capital gains tax. Okay, so this one probably explains it better. It's the selling price minus the cost basis times 50%. So if it was 200 and then you got it before with 100, that would be 100. So 200 minus 100 equals 100 times 50%. That's 50 of the 100. And then that's what's going to get taxed. Depending on the tax bracket that you're in, that's the tax that they'll use. Okay, final exam tips. So before you go into your exam, make sure you just do a re-review of your notes. Also, I would just say take a lot of practice quizzes, especially the mock exams. My best way of passing it back then was just keep taking the mock exams until you confidently pass it. It's like what I did with my driver's test. I just kept taking practice exams. I didn't really study for my driver's license other than just keep taking the tests until you pass, until you get bored that you're just passing, and then that's when you can just take the exam. Another would be if you go to your textbooks, you could just look at the client situations and then make sure you just read through it. And then there's also the formulas that you go through, because in the exam, that's mainly what they're going to be showing you. And once you get used to just getting familiar with the client situations, it's basically the same thing exams, but with just different names and a different number. And you just apply the formula and that would get you a passing grade. That is all that I have for today. I hope that you learned something from this video, and don't forget to like and subscribe, share it with others. And if you want the slide presentation, I will also leave a link down at the description. Thank you and have a nice day.